America versus China is back in the headlines, and most people are treating it like a political story. I understand why. Politics is loud, emotional, and it gives you someone to blame. But if you're an investor, it's not primarily a political story. It's a pricing story. It's a margin story. And eventually, it becomes a rate story. So today, I want to walk you through the one question that matters whenever people start talking about tariffs, retaliation, and economic wars. And that question is, and then what? Because the headlines are the beginning of the chain, not the end of it. Now let's start with the part that almost everybody gets wrong. People say, tariffs punish China. That's a comforting sentence because it implies the pain is exported. But tariffs don't work like a remote control weapon. Over time, a tariff behaves like a tax on goods, and somebody has to pay it. I've said publicly that over time, they are a tax on goods and that the tooth fairy doesn't pay them because the cost shows up somewhere in the real economy. The only debate is where it shows up and how fast. Sometimes, the exporter eats it, cutting their price to keep the customer. Sometimes, the importer eats it, accepting lower profit margins. Sometimes, the retailer passes it through in higher prices. And often, it's a mix of all three, changing quarter by quarter, depending on bargaining power and competition. That's why tariffs are so frustrating for markets. Markets don't mind bad news as much as they mind uncertain math. A company can handle a recession if it can see the recession coming and plan for it. What companies struggle with is not knowing whether their input costs will jump next month, or whether a supply chain will snap, or whether a major customer will delay orders because they're waiting to see what Washington and Beijing do next. And when investors can't model the next 12 months with confidence, they don't pay high prices for future earnings. That's the first domino. Now, here's the second domino: inflation. Tariffs can be inflationary, not always immediately, but through the same transmission channels that run the modern economy: shipping, parts, commodities, and expectations. If the cost of imported components rises, the cost of finished goods rises. If the cost of finished goods rises, the consumer's wallet tightens. And when that consumer is the American consumer, when that consumer is the engine, then you should pay attention. Because in America, the consumer isn't a footnote. The consumer is the story. So when you hear America versus China, you should not just picture a diplomat at a microphone. You should picture the pricing manager inside a multinational corporation trying to decide whether they can raise prices without losing customers. And you should picture the household budget in a suburb somewhere deciding what to cut. And then you should ask, and then what? Because when prices rise, central banks are forced to care. That brings us to the third domino: interest rates. If inflation becomes sticky, if it refuses to come down, then the Federal Reserve can't simply declare victory and turn the money spigot back on. Higher for longer becomes more than a slogan. It becomes the environment. And in that environment, high valuations become fragile. You can have the best companies in the world and still lose money if you pay too much. That's not pessimism, that's arithmetic. When rates are low, investors will pay a premium for future earnings because the discount rate is forgiving. When rates are higher, the same future earnings are worth less today. Multiples compress even if the business is fine. So tariffs can hit you in three ways. They can raise costs, they can raise prices, and they can keep rates higher for longer. This is why people who think tariffs are just politics are missing the real hazard. Now I want to make something clear, because this is where people get emotional. I'm not telling you tariffs are good or bad. I'm telling you how they behave inside an economic machine. And I've also said publicly that tariffs can be an act of war to some degree. That's not a line meant to make headlines. It's a reminder that tariffs create retaliation, resentment, and second-order effects that rarely stay contained. The investor's job is not to cheer for one side. The investor's job is to stay solvent and rational while other people lose their minds. So let's talk about who actually gets hurt first when this gets real. The first group is simple: companies with thin margins and import dependence. If you're selling a product where you make 3 or 4 cents on the dollar, you don't have room for surprises. If a tariff adds cost, you either raise prices and risk losing customers, or you keep prices the same and watch your margins disappear. That is not a political outcome. That is a spreadsheet outcome. The second group is companies with complex supply chains. Modern manufacturing is not one factory in one country. It's a choreography across continents. Components cross borders multiple times before a product is finished. A tariff doesn't hit once, it can hit repeatedly across stages. And this is where the "and then what" framework becomes powerful. Because it's not just tariff announced, it's tariff announced. Then suppliers renegotiate, then production shifts, then lead times change, then quality issues emerge, then inventory gets mispriced, then customers complain, then sales slow, then CFOs cut spending, then hiring slows, then defaults rise, then markets reprice risk. That entire chain can start with one policy line in a speech. Now let's take a case study that people always want to talk about: Apple. Apple is a wonderful business. It has one of the strongest brands ever built, and it has enormous pricing power. But it also lives inside the reality of global supply chains and geopolitical tension. When tariffs and trade restrictions escalate, Apple faces choices that are not easy: diversify manufacturing, absorb costs, pass costs, or shift product strategy. Those choices take time, and time is expensive when the market is pricing certainty. This is not a prediction that Apple collapses. It's a reminder that the best businesses in the world still face friction when the world becomes less cooperative. Now, if you want to think like a long-term owner, you don't ask, "Will this headline hurt Apple tomorrow?" You ask, "Does Apple have a moat big enough to absorb shocks over the next decade? And is the price I'm paying today giving me a margin of safety?" That's a very different question than the one most people ask. Because most people ask political questions. Owners ask business questions. And that's why I've warned against mixing political views with investing. I've said, you don't want to have a political view when you're investing, because it distorts your judgment. Now, I can already hear the pushback. Some people will say, "Fine, tariffs hurt, so I should sell everything." That's not rational either, because the next question is, and then what? If tariffs rise, businesses adapt. They renegotiate supplier contracts. They shift assembly to other regions. They redesign products to reduce dependence on certain inputs. They automate. They localize. They do what capitalism always does. It reroutes around obstacles. So the real investing question becomes, which businesses have the power to adapt quickly and which ones don't? That's where the concept of pricing power becomes central. In a world of tariffs and inflation, pricing power is oxygen. If you can raise prices without losing customers, you survive. If you can't, you suffer. Companies with strong brands, essential products, or regulated scarcity often have better pricing power. Companies that sell interchangeable goods often have less. So your portfolio should be built around a simple test. If costs rise, can this business protect its economics? That's what separates a wonderful business from a wonderful stock purchase. Now let's talk about China for a moment. Not as a villain or a hero, but as a variable. The US and China are deeply intertwined economically. They are competitors, but they are also counterparties. That's what makes this relationship so hard to reduce to slogans. When tensions escalate, it's not only about tariffs on finished goods, it's also about technology restrictions, capital flows, and strategic materials. You see it in semiconductors, you see it in rare earths, you see it in the movement of factories to friend-shoring locations. And again, this isn't just a story about geopolitics. It's a story about cost structure and resilience. Now here's the part that most investors underestimate: time. Policy changes rarely hit all at once. They hit in lags. A tariff announcement can be immediate. The impact on contracts can take months. The impact on inventory can take quarters. The impact on consumer behavior can take longer. This is why markets are so dangerous when politics gets crazy. The first move is not always the final move. Sometimes the market rallies on the announcement because people hear tough talk and assume it means better deals. Then, 6 months later, the earnings calls start to sound different. CFOs start talking about uncertainty, input costs, demand softness, inventory normalization. The language changes, the tone changes, and that is when the market quietly rewrites the valuation of everything. Not in one dramatic day, but in a slow grind that punishes impatience. So what do you do as an individual investor? I'm going to give you a practical playbook, not a prediction, not a trade, a framework. First, separate your identity from your portfolio. If you're cheering for America to win, that's your right as a citizen. But your brokerage account is not a ballot box. The market does not reward loyalty. It rewards accuracy and discipline. Second, stress test your holdings for a tariff and inflation environment. Ask 3 questions. 1. How much of this company's cost base is exposed to international inputs? 2. How thin are its margins? 3. Does it have the pricing power to pass cost increases through? If the answer is high exposure, thin margins, weak pricing power, you're holding a business that can get squeezed hard in an America versus China world. Third, respect liquidity. When politics gets crazy, volatility is not a bug, it's a feature. That's why liquidity becomes valuable. It gives you patience. It gives you optionality. It keeps you from selling a great asset at a terrible price because you're forced to raise cash. This is where people misunderstand cash. Cash is not there to make you rich. Cash is there to keep you from doing something stupid. It's there to ensure that if the market gives you a gift, if fear pushes prices below value, you can act rather than panic. And if you're wondering why someone would hold a large amount of short-term government paper during a period of uncertainty, that's part of the answer. It's not an emotional stance, it's a strategic one. Now let's talk about the part of this story that the average person feels, because it's real and it matters. The household budget. In a tariff war, the middle of the country doesn't see a spreadsheet. They see higher prices. They see a car that costs more because parts cost more. They see appliances and electronics creep up. They see businesses quietly reduce discounts. They see services rise because wages are rising, because costs are rising. And when that happens, consumers change behavior. They delay purchases. They trade down. They borrow more. Or they stop spending. That's not ideology. That's survival. And when consumer behavior shifts, corporate earnings shift. That's when stock prices shift. So if you want the honest, Buffett-style way to think about America versus China, you don't start with a political rant. You start with the consumer. You start with cash flows, and you walk the chain. Tariffs raise costs. Costs hit prices. Prices hit demand. Demand hits earnings. Earnings reprice stocks. Stocks reprice wealth. Wealth changes spending. Spending changes the economy. And then what? Now, one more thing. Because this is where fear can turn into opportunity. If the market sells off because investors panic at the word China, it doesn't mean every company is suddenly worth less. Sometimes, the market sells indiscriminately. It sells quality with junk. It sells strong balance sheets with weak ones. It sells businesses with durable moats alongside businesses with no moat at all. That is when the long-term investor gets paid, not for bravery, for preparedness. The goal is not to predict the next tariff announcement. The goal is to build a portfolio that can survive a range of outcomes and still compound over time. That means owning businesses with strong moats and pricing power, avoiding fragile businesses with thin margins and heavy exposure to cost shocks, keeping enough liquidity to avoid forced selling, and having the temperament to do nothing while other people try to trade every headline. Because the truth is, most people don't lose money because they chose the wrong country in a geopolitical rivalry. They lose money because they lost their discipline. They turned investing into entertainment. They turned a long-term game into a short-term emotional reaction. And markets punish that. So here's how I'd summarize the America versus China tariff story in one sentence. One sentence you can carry into every market cycle. Tariffs don't end in speeches, they end in earnings. If you can keep your focus on earnings, cash flows, and valuation, if you can keep asking, and then what? You will outlast the noise. And when the noise turns into fear and fear turns into opportunity, you won't need to guess. You'll be ready.